So, welcome one and all. This is the fifth Deal Deep Dive Live, performing an in-depth financial analysis that ideally does not suck. This one definitely won't suck. My name is Mitch Messer. I'm with Home Pride Properties, coming to you live from the sprawling metropolis that is Clovis, New Mexico. Although I do have high-speed internet as of yesterday, so I'm hot stuff these days. This is where we're going to review a live, or at least review an available deal in some city in the United States. And hopefully you've all done your homework so that we can have a lively discussion about how to analyze this deal and figure out if in fact is a deal worth doing, and possibly how to make it even better. So let's go ahead and get started. Let's talk about the ground rules as we always do. The main thing is I'm trying my best to respect your time and mine and not have this drag out. So I'm going to ask that you mute yourself until the Q&A. There'll be plenty of time for us to go through the deal. We're not going to, I'll stick around until there are no questions to be asked within reason, but let's hold our questions until we get to that part. And then the last thing is just try your best to keep up and be prepared. If we don't have enough liveliness going on, I will call on people. This is not intended to be entertainment. This is intended to be an active session for people who are serious about getting better as investors, as I think we all are. And so I do want this to be worth your while and mine, and that requires that we all be engaged. So I did this last call, and I'll do it again just because it's come up more than once. And folks have asked the question that appears to be the elephant in the room. And I think they think that they're waiting for the other shoe to drop, that I'm going to spring something on them. What's my motivation for hosting this call in the first place? It's a free call. I'm not selling product or services, and I won't allow anybody else to sell product or services on this call. That's not what it's for. This call came out of my frustration with seeing people on BiggerPockets on a regular basis asking questions about deals that they should know the answer to. If you can't answer questions about whether it's a good deal or not, then you need to start there. And so rather than complain about it, I figured, why not do something about it? So this is my attempt to raise the game of all of us by, what they say, metal sharpens metal, by us all working on getting our deal skills better and being faster and smarter about how we do it. So that's the motivation for this call. I do have an ulterior motive, but it's not probably what you're thinking. My ulterior motive is the better you get at analyzing deals and the more great deals you find, the greater the opportunity for me to JV partner with some of you out there. Some of the people that are on this call are already JV partners with me, and those folks know how to analyze a deal. You can't be a JV partner with anybody unless you understand what makes a good deal. And so I'm hoping to incubate some JV relationships as a result of this, but your wallet is safe. I have no intention of trying to get you to pay me anything for this call. It will remain free for as long as I'm doing it, because I do want to see people get this, because you can't be an investor unless you get this. So let's talk about the three phases of deal analysis. Now, I will say up front that I'm not suggesting that the things that I analyze for are the only things that are important. I am suggesting that if you do any kind of deal analysis, you have to go through, roughly speaking, three phases. And I think we can all agree what those are. And if you have a different opinion, hold it for the Q&A and we'll discuss it. But I don't see how you can get around phase one. You got to verify that you've got good data coming in, that you're starting from a place of actual information, which means you've got to get some sense of, if you're a buy and hold investor, what are rents? What's the neighborhood like? Facts like how many beds and baths, square footage, taxes, insurance. These are things that you need to know, and they're not guesses, right? I mean, okay, insurance, maybe you have to get a quote, but taxes, we know what it was last year. Depending how far into the year we are, we might know what it is for this year. You don't have to guess on that stuff, but you should have a complete as you can set of data that describes the kind of deal you're going to do. If you're doing fix and flip, you care a lot about after repair value. You care a lot about recent sales, but these are facts. You don't have to guess. You don't have to dispute these. These are not, there's no room for alternative facts when it comes to this stuff. There may be a range, but the range is not going to be all the rents anywhere between $500 and $2,500. That's not going to happen. So step one is to verify your inputs. Step two is going to be to achieve a specific financial goal. If you are a buy and hold investor, as I am, I'm looking for primarily two things. I'm looking for cash flow. I'm looking for cash on cash return. I have in mind, before I look at any deal, what I want in terms of cash flow and cash on cash return. So for me, running the numbers means putting my inputs into my equation based on the asking price and then seeing if I can get my goals achieved. If I can, I'm done. If I can't, then I have to make some adjustments, typically to the purchase price, to get my goals achieved. I do not change my goals so that the numbers work. I don't say, well, maybe I'll just take out vacancy so that I can get 10% cash on cash. No, because when you start doing that, you're no longer investing, you're gambling. Because vacancy doesn't go away just because you want it to. Vacancy is there because it's a real expense and you can't just wish it away. So goal achievement assumes two things. One, that you know which metrics you care about, and two, that you've thought through what your objectives are for those metrics. I'm a buy and hold investor. I care about cash flow and cash on cash return. Okay, great. Now, specifically, what cash flow, what cash on cash return? Just knowing that those metrics are important doesn't tell me what those numbers need to be in order for me to achieve my goal. And so I work my way backwards. If I want 10% cash on cash return and $200 minimum cash flow, then what kind of purchase price can I pay? What's the maximum that I can pay? What's my maximum allowable offer on this deal? And that tells me where my numbers need to be. Pretty straightforward. Finally, the part that I love the most, which is the deal enhancement. Okay, I work the numbers so I can get my 10% cash on cash and my $250, let's say, cash flow. Now the question is that the best I can do? Are there things that I can do that perhaps the average investor is not going to think about to make this okay deal an awesome deal, or make this awesome deal a tremendous grand slam home run deal? And sometimes there's not much you can do, but almost always there's something you can do to make the deal better. And better might mean better for you as the investor. Better might mean less risk. It might mean a variety of things, but that part is where the creativity comes in. And honestly, that's where fortunes are made. Almost everybody can do phase one. Most people can, if you explain to them how to do it, do phase two. Phase three is where you go from science rather, to art. And it's what makes good investors great investors. And I think we all aspire to be great investors. So let's talk in specifics about the actual steps or the elements of those three phases. For input verification, as I mentioned before, I am a buy and hold investor. I'm looking to buy properties that I'm going to put typically tenants in and collect rents to produce an income stream over time. So I care about after repair value, but I don't live and die by it. I'm typically not going to pay more than ARV, which is what I call after repair value, but I do need to know what it is so that I can make sure that I'm not overpaying. But I don't need a massive discount in order for me to do a buy and hold deal. If you're doing a fix and flip, then yeah, you care a lot about ARV, because ARV is going to dictate how much money you're going to make once you buy this property, fix it, and then sell it. And you can see here, I'm not going to read it to you, that there are plenty of ways to get after repair value. Typically, you're going to look at comparable sales. You're going to talk to a real estate agent and have them pull recent sales. You can take a look at any number of websites that speak to after repair value, and you'll get a range, typically a fairly tight range that tells you what the property is going to be worth once it's fixed. What I care about as a buy and hold investor is, since I'm going to be renting these things out, I want to know what's the fair market rent? What can I get for this thing realistically? Which is not necessarily the same as how much someone's paying right now. I see this all the time. Properties currently renting for $1,300, but fair market rent's $1,000. And that means the minute that tenant moves out, you're going to go right back to $1,000. And eventually that tenant's in all likelihood going to move out. So imagining that you're going to get $1,300 forever just because the person who's in there now is paying that is a huge, huge, huge beginner's mistake. Fair market rent doesn't change just because the person that's in there may be overpaying for any number of reasons. You need to know what the actual market rent is going to be if that person moved out tomorrow and you had to start from scratch. There are lots of places to get it. I like Rentometer. I typically don't trust Zillow, although I'll look at it. I don't typically trust it. I like Rentometer better. You cannot effectively use MLS because most rental properties don't go through MLS. Most people rent their properties independent of MLS. So the data you get there is not particularly helpful because so much stuff is missing. I do want to talk about repairs a little bit longer than I normally would, just because someone asked, I forget who it was, in the last couple of days, asked about repairs. As I think most of you know, because I'm here in Clovis, New Mexico, and I don't typically do a lot of investing in Clovis, New Mexico, all of my activity is done out of state. So I'm looking almost always at areas where I'm not physically going to be on the ground looking at the property with my own two eyeballs. So I need to rely on others to look at the property, ideally take a whole lot of pictures or a really good quality video, and then I can either look at that myself or get other professionals to look at it and approximate what repairs are. That is one way to get it done. Another way is just to hire yourself a property manager or a contractor to go out to the property and eyeball it and report back to you what it needs to make it rent ready. But I'm here simply to say that there is definitely a path for getting repair estimates when you're not physically in the same location as the property. I can't tell you the last time I physically went to a property to see it. When I was living in Atlanta, I didn't see properties physically before we bought them. I didn't need to see it. As long as someone saw it, that was good enough for me. And so getting your team to help you do the estimation is important, but seeing it yourself with your own two eyes is not essential. It's nice if you can do it, but it's right now when no one's traveling or hardly anybody's traveling domestically, I'm not going to hop in a car and drive to Texas to take a look at a property and try to guess repairs. I'll find somebody local who can go and take a look at that property and report back to me. Property taxes, it's as a matter of fact what the taxes were last year. I can look that up, and I can, in fact, I can look at the last several years, and I can do an approximation. I can do an extrapolation of what I think it's going to be this year based on that. But it is a fact. And insurance, it's a range, but if you have a local insurance broker for wherever the property sits and you ask them how much would it cost for 123 Main Street, landlord policy, annual premium, within a couple $100 they can tell you. So none of this stuff has to be guessed at, is my point. You should be able to reasonably assess what these are going to be for any given deal. And you shouldn't have to rely on hand waving or wishful thinking. Goal achievement, I'm going to mention here what my objectives are. My objectives are cash flow and cash on cash return because I'm a buy and hold investor. If you're in fix and flipper, you're typically looking for how much cash you pull out of the deal. So you buy it, you fix it, you sell it retail, and then at the end of all that, you put so much in and you got so much out. So you could theoretically calculate a cash on cash return for that as well. And depending on how long it took you to do it, you could annualize that cash on cash return and say, well, this equates to a 20% cash on cash for the year. But so whether you're doing it as a fix and flip or a buy and hold, or you're doing vacation rentals or commercial, whatever it is, whatever the investment is, the whole point of being an investor is you get more out than you put in. If you're getting less out than you put in, then that's not investing, that's donation. So everybody cares about some sort of return on investment. I personally care about cash on cash. It's not the only way of measuring return, but it is one that makes it real easy. How much cash did I put in? How much cash am I getting out? And then cash flow is the spendable cash that the deal is going to produce at the end of each, in this case, month. And those are the two things that I care most about. And I said already what my objectives are. When I'm talking about Atlanta and I'm looking at a deal, I want no less than $200 a month positive cash flow, and I want about 10% or better in cash on cash return. And then finally, deal enhancement, I'm gonna hand wave just because there's no strict definition of what that is. Deal enhancement is anything that you do that makes the deal better, kind of by definition. It could mean getting extra return. It could mean increasing your cash flow. It could mean minimizing your risk. It could mean providing benefits to the seller that they weren't aware of. It's all the creative stuff that it's hard to find a book that says step by step, do this, do that, do the other, because it's going to depend on the actual situation that you're in. But understand that this is where you go from an okay deal to an incredible deal, and a lot of other lesser investors will just take the deal that they got from phase two and go run with it, and never realize that if they'd done a few creative things, they could have squeezed an extra 2 or 3 or 4% of cash on cash return out of it, or they could have dramatically reduced the risk, or they could have, done something cool and beneficial to the seller. And so this is where you're going to, I think, learn how to go from good to great. So those are the 3 steps. This is our target property for today. It's 118 Cabot Street in San Antonio, Texas. There wasn't a lot of information here on the internet, so we're going to talk to the presenter about some of that. It's a 3-1 with a detached garage, just over 1,000 square feet, built in 1954. It appears to be a ranch. And the Zillow page said that it did not, well, it was silent, I think, on whether it had central AC. So I'll ask once we get to that point. But that's the house that we're going to be analyzing. And the presenter is going to be Mr. Andy Diego, who's going to walk us through this deal. And Andy's an investor in San Antonio. And he's got quite a bit of experience analyzing deals, and I'm looking forward to having him present this. This is his Bigger Pockets ID. I've said this before, and I'll say it again. I strongly encourage you to leverage each other's networks and expertise. So find Andy on Bigger Pockets, congratulate him after this call is done on what a wonderful job he did. But make these people part of your network, because I'll be blunt, I'm doing that for all of you. That's one of the reasons why you're on this call, is because you're part of my network now. So if I ever need, and I've talked to Andy about this, if I needed someone's help in San Antonio, I'm picking up the phone and calling him. So you have the same opportunity. He's a great guy, and you're welcome to, in fact, I encourage you to reach out to him and connect. This is the link, the bit.ly link for the deal if you want to follow along with us as we go through it. And oh, I completely forgot about the poll. Sorry, Karina. She's probably thinking, what the heck is he doing? We were supposed to do a poll early on to ask you guys some questions, because we have never tried the polling feature. So if, Karina, you would, let's try to do a poll now. Either one. We can try the either of the 2 polls. It doesn't really matter which one. But let's try to do a poll. And while we're doing that, I will transition over to Andy, let him get set up to set up his screen share so that he can walk us through this deal. And Karina, I don't know if there's anything I need to do special to do that, but I'm going to stop sharing, and Andy, you can start sharing.
Sounds great. Thanks.
And
thanks for the intro. I'm gonna go ahead and start sharing now. Can you guys see my screen?
Yep, I can.
Okay, perfect.
Let's see if Karina, oh, okay, so Karina has put the bit.ly link into the chat. And Karina, if you have the ability to do the poll, I don't know if there's anything special I need to do to make the poll happen.
We did the poll, and we've had all 15, so I'm going to end the poll now. Everyone has voted on it, so I'm going to end the poll, and we're going to keep going.
Awesome. That was quick. Okay, so let Andy take it away. It's your, you have the floor, and tell us what you got.
Well, apparently those are the results of the poll, if you can see my screen. Finding the deal seems like the hardest thing, and financing, of course, is hard if you don't have a deal. So I can see how that goes hand in hand. And unless you're wholesaling, finding a buyer isn't really too much of a concern. But okay. Hey guys, so I am a wholesaler in San Antonio. I've been wholesaling for about 1.5 years now. I'm from South Florida, but I moved to San Antonio, and it's a pretty great market, very active, a lot of off-market hunts for single families. And so this is one of my latest ones. I'm pretty proactive about how I go about finding deals, always off market, usually, vacant houses, behind on taxes, and, with heirship implications because the original owner passed away and then you have to track down the heirs. I do all that hard work so that my end buyer doesn't have to. So on Redfin, it's my preferred tool. It kind of gives me an overview you know, the beds, baths, square foot, the estimated ARV, which usually is kind of accurate. Sometimes, especially with newer builds, I found that they're very accurate in San Antonio. But when they're houses that are a little older like this one, you definitely have to take it with a grain of salt. But in this case, it definitely was a bit more accurate. So here's my analysis. It's pretty simple. I went ahead and made 2 tabs at the bottom, if you follow. The first one's about the rental analysis, BRRRR strategy in particular. And the second one would be about if you were gonna fix and flip it. As a rental, the ARV would kind of be lower. And like Mitch said, it's not as much of a consideration because you really just want cash flow and cash on cash when you're renting. But the reason the ARV might be lower when you rent is because you don't make as much improvements, of course. You don't need to make it super pristine to get someone in there and pay fair market rent. And so I determined that the ARV conservative for a rental would be about 140,000 in this case. My proposed wholesale price would be 80,000 for a buyer. I do have it cheaper, of course, because it's a wholesale deal, but just seeing if this makes sense for people. The buyer would pay closing costs, so usually about 2% as a quick and dirty rule of thumb, and to get it rent ready, about $15,000. Mitch alluded to the AC. Yes, it's not central, so that would need to be done. In San Antonio, the repair costs, especially in houses in kind of more blue collar neighborhoods, tend to be pretty cheap. So an AC can run you between $5,000 and $7,000 for central. It's not too bad. And so apart, like more repairs would be just kind of, you know, carpet paint, landscaping, appliances, but nothing crazy. The foundation's good, the roof is good. I think the AC is the main thing. But I determined—
So Andy, I'm sorry, just to briefly make sure I'm clear. So your estimate for the HVAC is about, call it 7 worst case and 8,000 for the rest?
Yeah, you wouldn't need to do too much because it's actually in pretty good shape. The person, this was actually a referral from another— I was working with the same family on 2 other properties that they owned. And then one of their family members passed away and they're already talking to me, and they called me. So there was someone living in that property up until a few months ago. So it was kept up. So the repairs aren't too bad.
Got it. Got it. And it looks like its exterior is at least partial brick. So presumably it should be in pretty decent shape on the outside.
Yeah, it's not too bad. It has— the landscaping's become more of a concern because no one's lived there in a few months. So they let that go. But and the other consideration too is with vacant houses, especially now with what's going on, we've had to take a special precaution to avoid squatters getting in there. So
Yep.
we turned on a TV nice and loud so that nobody would go in, and it's been working. And we also have the neighbors helping us, you know, just in case anyone goes in, to call the cops immediately. So that's something you actually have to think about, unfortunately.
Smart. Nice.
Yeah. And so the rent, I determined $1,050 on Rentometer. I have Rentometer right here. The property is right here next to a Walmart, which is very nice. The street it's on is very small. It's a very private, nice green area. The blue is more the median pricing. So I kind of just went with the median pricing. And especially since it's close to the highway and the centers, but doesn't feel like you are. I'm sure people really like that. But I did not verify with a realtor or a property management company like I would if I were serious about keeping this as a rental, to really find out what the rental price would be.
Got
it. The property taxes is interesting. You guys doing your analysis probably found a different number because it was an airship situation. So the person who owned this was only paying $470 a month, a year, sorry, which is crazy. They have an over 65 homestead exemption, which means that if they wanted to in Texas, they wouldn't have to, or at least in Bexar County, they wouldn't have to pay taxes for the rest of their life. They can defer it, and it just racks up, and people often do that. And so when you find a tax delinquent house in San Antonio with an over 65 exemption, it's not really indicative of distress necessarily. But in this case, she kept up with it, which I appreciate. So I had to be creative. because when you buy a property, this is an old rate from when she owned the house I think she bought it in the 50s. So you have to kind of get that modern rate. And so what I did was, I like Redfin a lot. Redfin, I'd go on the recently solds and for sales, and the for sales, like this one here, they give you kind of a breakdown of the monthly expenses. So when I clicked on it, it was this property, 123 Barrel, listed for a little over, or over the ARV that I calculated. It has an extra bath, but so that makes sense. But when you scroll down, you see this breakdown. And so I basically just use this as a guide for how much my insurance would be and my property tax would be. Again, if you wanted to do it very diligently, I'd call the tax office, ask them what it would come out to at a certain purchase price, because it depends on the purchase price. And the same for the insurance. I'd call a company and get a quote. But this is Pareto's principle, just going for the quickest, most info as quick as possible. So
Sure.
I made that assumption over here with the taxes and the insurance. I also included a 1 month of vacancy. So that's technically something around 8.5%. I think it's 8.67, but I just said 8.5. Maintenance 5%. Capital expenditures, the big ticket items like roofs, ACs, all those things that you have to maintain or replace, that's there. And if you don't want to deal with it, you hire the property management company at a typical rate of 10%. And that comes out to your total monthly expenses if you were to buy with cash. Because if you were to have a mortgage, then you'd have principal and interest to deal with. But that comes out to a cash flow of about $350, which is pretty nice. But then your annual expenses, just multiplying these, of course, by 12, you come out to a total annual expense of $8,400 and a cash flow of $4,200. The net operating income in this case is just basically the cash flow, because there's no mortgage in place. And the cash on cash doesn't seem very flattering, but mind you, this ideally would be a temporary situation, given that you might want to BRRRR it. And when you BRRRR it and you take your money out, you're going to have a higher cash on cash return, because you're going to have less money left in the deal.
Hey, Andy, before you go on to the BRRRR exit, I want to walk through the numbers a bit more carefully, just because I know that there are folks here who see this, do this all the time, but there are folks who may need us to slow it down a bit. So to your point, the $350.75 in monthly cash flow, you multiply that by 12, and that gives you your 4,209 in annual cash flow. Tell me again why the cash flow is the same as the NOI, or more importantly, before you go there, tell me what the NOI is. What is net operating income? How do you get to net operating income?
Basically, net operating income is your net expenses, basically your net profit, not including the mortgage. I think I don't really know how to define it perfectly, to be honest. I think you're better.
You're there. So it is your income minus your net operating expenses. I mean, sorry, your total operating expenses.
Right.
So the things that you have there, the taxes, the insurance, the vacancy, the maintenance, the CapEx, it's all that stuff, not counting your finance charges. Finance charges, debt service is not part of net operating income. But in this case, it's a cash deal, so there is no finance charges. So net operating income is just your income minus all your operating expenses, the things that you have to spend money on to run the business, or in this case, to run the rental. You got to pay taxes, you have to have insurance, so you're going to have vacancy, maintenance, CapEx. So those are property management. Those are things that are considered to be operating expenses. So what you have as D14 are your total annual expenses. So you're subtracting, in fact, yeah, okay, there you go. So if you look at D, it's like playing Battleship, D16, I assume that D16 is D7 minus D14.
Yep,
there you go.
In the formula.
So it's your total income, which for this rental is going to be just rent, minus your total annual expenses, more specifically, actually, your total operating expenses. And then that's what you've got as net operating income. And I'm not trying to beat this dead horse, because I do want people to get this.
Right.
What would be, so in the case of this, your cash flow would be your net operating income diminished by or less your finance expenses. So if you had a mortgage payment, that payment would come off of the net operating income, and then that would be your cash flow. And cash flow is what it sounds like. It's how much spendable money do I have at the end of the year? Because unfortunately, you still got to pay a mortgage. And so you don't get to not spend that money, even though it's not an operating expense, it is an actual expense. So your cash flow is typically going to be less than your net operating income, because you got to pay for financing if you have any. But let's talk about this cash on cash return on investment, which is vitally important. How do you get the cash on, well, okay, you've got the formula there. So you get cash on cash by, it's a simple division, numerator at the top, right? Denominator at the bottom. The numerator is all of your input, all of your return, all of your gains, all of your money made, your cash made, in this case, net operating income, divided by all the cash you had to put in to get that. And in this deal, you had to put in $80,000 to buy it. You had to spend $1,600 to do the closing costs, and you had to spend $15,000 to do the repairs. So you got 96.6 in, and that's going to be your denominator. So 4209 divided by 96.6 should give you 4.36%. That's how we came up with that number. Last thing, tell me about the importance in this calculation of cap rate. I have to do it because some people out there are still clinging to this notion of cap rate. Where does cap rate fit into any of this stuff? Let's talk about what is your cap rate.
Honestly, I didn't even bother calculating that because you have talked it down so much. I'm just like, I'm not even gonna do it. And it's out of my mind. Well, I couldn't even explain it like you could.
So
I think you're off.
So, and I don't want, I'm not trying to beat you up. I'm not trying to beat anyone up on the call about cap rate. Cap rate for commercial real estate, absolutely something worth talking about. But cap rate, the best metaphor that I can think of is to talk about stocks. When people talk about technology stocks, or they talk about utility stocks, they talk about a particular or high-tech stocks. They talk about a particular category of stocks having a traditional price to earnings ratio. And if you think about it, cap rate is just, it's a price to earnings ratio inverted. It's earnings over price, not price over earnings, but it's the same thing, right? And so someone will say, this sector, the healthcare sector is trading at, you know, a 10 price to earnings ratio, that people are willing to pay 10 times earnings for this stock. That's true for the category. It says nothing about whether any individual stock is good or not. No one says this stock is a, 10 PE ratio, because it doesn't work for individual stocks. Same thing with same thing with cap rate. Cap rate is intended to be for a category of property, for an asset class in a particular town. So in Chicago, apartment complexes may have an 11% cap rate.
Mm-hmm.
But that says nothing about whether your apartment complex is going to make you any money. It's not the same thing as a return on investment at all. It's simply a ratio of net operating income divided by purchase price. And if you think that's a useful ratio, then my question to you is, where is, repairs in that? What if the property needs a ton of repairs? Well, that's not a factor in cap rate. Well, how can it not be a factor? Well, it's not a factor because that's how cap rate is calculated, but that's why cap rate, for the purposes of these kinds of analyses, are useless, because it doesn't tell you how much money you're going to make. It's at best a way of valuing a property when you get ready to sell it. But again, for the purposes of single family houses, let's all agree there is no need to even talk about cap rate. When someone tells me that they're looking for a cap rate of anything on a single family house, my newbie alert goes off, because I know they have no idea what they're talking about. So please don't do that. If you're going to talk about a cash on cash return, you got my attention. If you're going to talk about, there's a bunch of other metrics that we can talk about, but cap rate for the purposes of a single family house has no significant meaning. So anyway, I just wanted to have my little rant. I'm done with ranting. Let's talk about the Burr exit. Before I do that, I'll keep my eye on the chat. Any questions from anybody out there about anything that has been said so far? Everybody good? Anybody contest Andy's rent or tax? Well, I guess, it's not much we can contest on taxes or insurance. Anybody have any issues with anything that we've said so far?
Hi, this is Arturo. Can you hear me
Hey,
okay?
Arturo. Yep, sure can.
I'm just curious about the closing costs. From my experience, the number is closer to, at least for my one experience, it's closer to like 9,000.
Whoa.
9,000.
No, that's
I'm
way
just
high.
curious
Well,
how you
so
that's-
let's ask this. Let's not use the number. Tell me what percentage that was of the purchase price. If that was a $900,000 house,
10%. It was a single family for 107,000.
yeah, no, that's way high. And let's be clear on what we're talking about with closing costs. Again, this is a cash transaction, so there's no. Yeah, you got to do title. Yeah, you got to do attorney's fees. Yeah, you're going to get title insurance policies. You're going to get that stuff's got to be done. You got to pay transfer taxes, but there is no. Obviously, there's no appraisal here. There's no points.
Yeah, I think that's the difference. Yeah. Okay,
Yeah.
that makes sense.
Yeah. So and in fact, for me, if this were Atlanta, even 1,600's on the high side. I can typically get away with like $800. Our closing attorney charges $500 ish for a closing, maybe a couple $100 for title exam, transfer taxes, maybe 100 and change. So we're talking typically around 1,000. But every market varies. I know nothing about the Texas closing, so 1,600, if that's customary, that's fine. But yeah, I suspect most of that 9,000 was banks with their hands deep in your pockets, taking your money, which is what they're best at. But good question. Any other questions out there? Again, folks, this is the nice, safe environment where you ask these questions. I'm not here to embarrass anybody. None of us were born knowing any of this stuff. I didn't know this 20 years ago either. So this is the place where you ask these kinds of questions.
Hi, Mitch.
Hey, Anthony, how are you?
Doing well. How are you doing?
I'm doing great.
Good. Great job, Andres. I have a quick question regarding the taxes, because I saw wherein the person was getting a homestead and was over 65. So I had assumed that the tax of 470 was low because of the homestead and over 65. Mm-hmm. So I was putting the taxes a little higher, saying the person was getting a break because of the homestead and over 65. So I was a little surprised that you used 250. I'd used like 500.
So this was 479 for the year.
Yes, for the year.
He was doing 260 for the month.
260 for the month.
He's got 3,000 for the year.
So
3,000 for the year. Oh, okay.
Yeah. So the way I came up with that, because like I said, the owner of the property owned it since the 50s. So that was way back then. Now, if you were to buy it, I went ahead and I went to, because on Redfin, they give you the breakdown.
Okay.
So active properties. This is the active property. And this one pays $286 a month, like theoretically. And if I were to go on this website for this property, I'd probably find that $286 like per month. So that's how I came up with that.
Yeah, perfect. I was just saying $500 for the year, since they had paid $470 for the year and they were getting homestead and over 65. But that justified what you're saying there, the 3,000. Yeah.
And Texas is known for its taxes, so I'm not surprised.
Okay.
Andy, you have another question in the chat from Kevin. How was the ARV determined? He mentions that there's limited information online for comps. You did touch on that a little bit, but say a little bit more, if you would, about the ARV.
Sure. Yeah, the ARV, like I said, Redfin tends to be pretty accurate in San Antonio, but of course, you have to do your due diligence. I don't have access to the MLS, so this is the closest thing I've got right now. I located it. The property is actually right here. This was the closest thing. So I clicked on that, and you could also see that it's a 3-bed, 1-bath, 1008, 3-bed, 1-bath, 1014. So it's very good, very nearby, same size. And it was only on the market for 11 days. So when you go on this property, completely rehabbed, like this is almost good enough to just be like,
Nice.
it's a great comp. Then when you scroll down, Redfin gives you a listing history. It was listed for 142.5. They sold it for above. It was listed for a month, pending within a week. So that means that it was underpriced. So 140, I think, is pretty conservative. But like I said, I actually think the fix and flip ARV is higher, which you're going to see next, because you would have put in more to justify a higher price. Rentals, you don't make it pristine necessarily. But yeah, I mean, that's an ideal situation. Sometimes you don't have that. Sometimes you have to use, the Redfin has a table breakdown. So I'll go here to the table, and then you could sort it by square footage. And then you can go on the high end, and you can kind of like compare, like, okay, this is the high end 150, 145, 140. If you want, you can say 140 to 150 per square foot. Maybe 145 a square foot is a good metric. But you see here, it's fairly consistent. This one's right here. So yeah, you have some good comps in this one, fortunately.
Yeah.
Hi.
Yeah.
Just another question on my side. The purchase price of 80 is what you're paying for it?
No, so I'm a wholesaler, and this is my proposed sales price to a cash buyer.
Okay, thank you.
I do have one quick question just regarding the closing costs. Is 2% generally, I mean, I know, I feel like you kind of mentioned it, right? And as you just mentioned, right, you're putting this up for like a wholesale deal. Would you always stick to that 2%, maybe 2.5% if you're trying to leave some wiggle room as far as the, or I should say 2% off of the purchase price and not necessarily the ARV?
Yeah, no, it's always off the purchase price. So
Okay.
this is off the purchase price. If you see the formula, it's B3, which is this cell. And I honestly just chose 2% because bigger pockets. I read an article one time that said, I think from Brandon Turner, you go figure 2% for closing costs. I'm like, okay, that's gospel. I'll do that. So honestly, if I were to break it down, it could be like Mitch said, it could be 800 or 1,000, but it's not really worth my time to really break it down. I think that's reasonable enough, plus or minus 0.5% or 1%. So,
and then this is just because I'm new to the whole wholesaling. Obviously, when you wholesale, as Mitch kind of alluded earlier, right, you don't necessarily have the banks in your, with their hands in your pockets. So you'll generally be able to go with that 2% rather than if you are getting financing. Would you assume higher? Is there a percentage maybe that we can just kind of have in our minds based on that, Mitch? What are your thoughts on?
It's definitely going to be higher. It'll be dependent on the lender. I almost always, when I'm presenting a deal to an investor, as Andy is here, this first spreadsheet is intended for his buyer, his end buyer. I'll run the deal cash and let them put in their closing costs because they and their lender are going to negotiate that. That's not my fault. And so I'm not setting those prices. That's going to be entirely dependent on their lender. And so whatever it is, they'll tell me, and I'll happily update the spreadsheet if they want me to. But for the purposes of this, I don't worry so much about the finance costs because I don't have to protect against those costs because they're introducing those. When I'm wholesaling, I'm almost always assuming my buyer is going to be a cash buyer. And so they're hardly ever getting financing, at least not with me. They may go after the fact and refinance it, but with me, they're doing a cash transaction. So I usually just use the actual cash transaction closing costs. But you could talk to a few lenders. It looks like someone mentioned in the chat, I think it was Sully mentioned in the chat that he had seen much higher closing costs. Any lender will, lenders are happy to tell you how much they're going to jack you at the time of closing. But when it comes to presenting it from the buyer's perspective, my recommendation is use cash and find out from your attorney what the actual cash charges are, because no one can argue with cash. And then your buyer can insert their own numbers to get what they're actually going to be seeing in terms of cash on cash return.
Understood.
Does that make sense?
It sure does. Thank you, guys.
Cool.
Yeah, so that's the cash purchase basically. The cash on cash return is not super sexy, but it's a starting point. with the BRRRR exit in mind. So once you incorporate that, you get a lot of your cash back, and really it's a sliding scale. You determine how much you want back. Here I just said 35%, but you could, you know, be eligible for up to 75%. Just kind of depends what you want. But mind you, the more you take out, the more monthly payments you're going to be responsible for, and that might kill your cash flow. So you have to find that happy medium. And here I kind of proposed it at about 35% because you recoup, you know, about half your money or so, which, you know, a good BRRRR, you get all your money back and cash flow. But the rents here aren't high enough to justify taking out that much. And so when after you stabilize a property for typically 12 to 18 months, you can get a cash out refinance. And you, like I said, you kind of decide how much you want out, up to 75% typically. And with the cash out refinance, yeah, the closing costs might be a bit higher, but since you already repaired the property, you can assume that you've done all the big things. You don't really have to do anything. Maybe there's, you know, your tenant's probably still in there, hopefully, but you don't really have to account for repairs at that point. And then the cash left in the deal is important because that's going to determine your cash on cash return at the end. So here, a year later, I assumed that the rent would go up $50, which I think is reasonable. It could go up more, but we'll just say that. I looked up the typical interest rates right now, and 3.5% seemed about right for a 30-year fixed, which principal and interest is only $220.03. I use a website called Mortgage Balance Calculator, or mortgagecalculator.biz. You put the value, all these inputs, and then it spits out your principal and interest payment, and also your equity percentage, your loan to value. So it's kind of nice, but that's how I came up with that number. And again, the same assumptions for taxes, insurance, vacancy, all that. But your total monthly expenses go up because now you have your mortgage payment. So your cash flow goes down compared to before by the amount of this, and, you know, by those changes. Multiply by 12, as Mitch was saying, you don't include the principal and interest, this figure here, in your net operating income, but it is very important for your cash flow. So your cash flow is cut in half, but now you have free liquidity. You got back $49,000 to put into your next deal. And at the same time, your cash on cash goes up. Your net operating income just changes based on the rent, pretty much. And yeah, so you kind of get that figure, and that is justifiable exit as far as cash on cash return, because otherwise you're just returning a little over 4%. It's never really ideal in real estate to leave all your money in a deal. If you buy cash completely, usually you want to get out as quick as possible. And if you want to get out as quick as possible, but still own the property, BRRRR exit is one of the best strategies out there. So I don't know if anyone has any questions about this, but your cash on cash goes up because your cash left in the deal is less than before.
Yeah, very nice, Sandy. I do want to walk through this BRRRR exit because I'm going to assume that there are people out there right now who know what BRRRR is and some people who don't. So let's talk about
Okay.
BRRRR. It's a fairly popular acronym on Bigger Pockets. It stands for buy, renovate, buy, renovate, rent, refinance, and repeat. And this is a perfect example of it. You bought the property cash, you made the renovations, $15,000 worth of renovations. You put a tenant in there at $10.50, and then you go to a bank and you say, "Hey, bank, I want you to give me a mortgage on this property." Or actually, I'm going to give you a mortgage on this property. And the bank will say, "Okay, let's see what it's worth." And they'll do the appraisal based on our ARV. If we had our numbers right, they'll come out with an appraisal of $140,000 for the property. The bank is not going to lend us $140,000 on the property. Banks typically won't go more than about 70%, 80% loan to value. And in our case, we're only asking for 35% of the actual value of the property as a loan. This is that cash out refi line. So we're asking for a loan of $49,000. Bank says, cool. For $49,000 at 3.5%, your payment's going to be $220.03. That's where that payment comes in. And you start making payments immediately. Kevin's asking if you can use an a HELOC, a home equity line of credit. Absolutely. But in the case of a HELOC, your rates are going to be typically higher. You are not going to have to get an appraisal because you've already, your HELOC is already leveraged against whatever real estate assets you've got that gave you the, I'm sorry, I'm trying to read and talk at the same time. They gave you the HELOC in the first place. But if you could, the issue with the HELOC is that you can use the HELOC to do another deal, but the HELOC is not going to get your cash out of this deal. The issue for this investor is that they sank 96.6 into this deal in the first place. And so they want to get their money out so they can go do another deal. So in order for them to get that money out, they have to go to a bank and get a loan. And the hope is that there's enough cash flow on this property to support the money that they're going to take out. And that's in my case, with respect to this deal, it's, that is the shaky part of this deal is that if I put 96.6 in, this is basically telling me that I can only support getting about half of that out and still be able to service this $220 worth of monthly debt. If I wanted to take all my money out, I would be negatively cash flowing. I couldn't, if I wanted to double that 49 to, well, I guess I couldn't double the 49. If I wanted to well, let's make the math easy for me. If I wanted to go to 70% loan to value and made that 98, it goes to 440 in principal and interest instead of 220, which puts me in the negative category. So if I want to get, well, okay, it's a bit more than my money. So I guess I should only be able to get 95 out because I've only got 5 in. So my only point is that if you wanted to get enough money out to do this again, I guess the 96.6 is what I put into it. Then I couldn't pull all my money out because this deal won't support that and cash flow. So I can only pull out about 49,000. Well, I can pull out 49,000 and have a cash flow of 166 each month, which concerns me because, as I've said a couple times on this call, maybe not in San Antonio, but in Atlanta, I saw in 2008 rents go down $200. $1,000 property just like this one go from $1,000 in fair market rent to $800. And if you lost $200 a month in positive cash, lost $200 in rent, now you're negative, right? So now you're carrying $40 you're feeding this thing $40 a month just to keep it. So I would be a little anxious about the burst strategy for this one just because I can't get all my money out. So when I take up that 49,000, I could then go do another deal, but now I can only buy a $49,000 deal for cash as opposed to the 96 that I put into it. Does that make sense? Anyone have any questions about that? I know there were a few questions asked in the chat and I was trying to read them while I was talking. I think other people are responding to them. And I think
yes, Mitch, and that was my question is why not include your original cash in the amount of money you were going to pull out for the Burr exit, and that makes sense. You'd be having a cash on cash return in the negative.
Correct. So if you try to pull it all out, this deal would support pulling it all out. It supports pulling some of it out, but the amount that it supports pulling out is like a little bit more than half. And that means if you bird, it's like, I'm sure there's a geometric progression, but you put in 90,000 for your first deal and you only have 40 some odd thousand for your second deal, and you only have $20,000 for your third deal because your pile keeps getting smaller and smaller as you're burning it up to service your debt. And I also, I'm anxious. Certainly rates are low right now. I don't, and Andy's absolutely right. You can't turn around after 2 months of this and say, hey, I want to go ahead and refi. The banks want to see this arrangement season for at least a year and a half before they're going to give you any money on it. So you'd have to tolerate that 4.36 cash on cash return for at least a year and change before you could turn around and try to refinance out. And who knows where rates are going to be in a year and a half. I mean, I think it's safe to say for the next 6 to 12 months, it's going to be fairly low. But if that goes to 4 or 5, now you're in trouble, because now you don't, even if you try to refinance it, you can't get enough money out. You can hardly get any money out and have it still make sense. And again, I'm not saying that the numbers won't work. I'm just saying, for me, the weakness of Burr, in my opinion, it's not about this particular deal, it's just in general, the weakness of Burr is that it assumes your ability to refinance is going to stay fixed forever going forward, and that rates aren't going to go up. And I think they won't go up immediately, but I think it's only a matter of time before they start to. And when they do, a lot of people are going to be on the outside with their faces pressed against the glass, because they're not going to be able to get 3.5% 30-year fixed. And if that 3.5 goes to traditionally where interest rates have been, more like 5, 6, 7, 8, then they're out of luck, because then they can't get the money out at all. So I'd say be careful about this. But for the purposes of illustrating this kind of a deal, this is an awesome analysis, and I think this is great. I'm trying to read the comment. Anyone have any questions, comments while I read the chat?
Yeah, I was just wondering, as far as a margin of safety for rent, so you were saying with a single family property, have at least $200 worth of cash flow, so in case there's any correction. Now, as far as with multifamilies, does that 200 per unit continue, or would you say like 100 per unit is good enough of cash flow every month?
Yeah, I would say something less than 200, probably something more than 100, maybe 150. I just want there to be some room in there, because again, while I'm not suggesting that the downturn that we're about to face, I think it's official as of this week that we are now in a recession. But just because we're in a recession doesn't mean rents are going to go down. I think that's going to be particularly relevant. In some markets, rents are going to continue to go up because there's more demand than there is supply. And so the recession isn't going to change that. It's going to make it suck for a whole lot of people who are going to have to face losing their job and having to pay way more rent than they were before. So it's going to be hideous for those folks. But I'm just saying, make sure that you're not running on fumes, because stuff happens. Repairs pop up out of nowhere, tenants move out, and your vacancy that you thought was 1 month out of 12 becomes 2 months out of 12. And so just give yourself a little bit of room. 6 months ago, I still saw people doing deals with like $75 in positive cash flow. And I just rolled my eyes, because I'm like, that's a disaster waiting to happen. It doesn't take much to eat $75 a month in positive cash flow. That's effectively zero. And if anything goes even slightly wrong, before you know it, you're in the red. And I've been there. That's exactly where I was in 2008. And that's bad enough on one property. Imagine that on like 30 properties. It gets really ugly very, very fast. And in fact, the reason why we crashed and burned so hard is because we had over-leveraged properties that when you lost rents and asset values, you couldn't sell. I mean, imagine this scenario. You borrow $49,000. I mean, this is actually a pretty good scenario, but imagine if the appraisal is 140, and then a month later, there's a massive correction, and that 140 is more like 100. So you lose $40,000 worth of equity, 20% worth of equity in a month. And in some cases, if you borrowed, say 100, now you're barely treading water. In some cases, you could be underwater. So you can't sell it unless you're going to come to closing with cash, and you can't hold it because you get negative cash flow. You're just screwed. And that's pretty much what I was in 2008 and 9 and 10 and 11 and 12. So I warn people to be very careful about banks and about financing. I know there are people on this call right now who may or may not chime in, who have experienced what happens when banks get scared. When banks get scared.
Can I chime in? Sorry,
yes.
I didn't mean to interrupt. So this is so. Yes.
Yes. You know where I'm going, right?
Yes. So Mitch and I had a conversation literally right after we got off the call last week. So basically, my partner and I were getting on our first deal. Everything was going well. That we were supposed to close 2 weeks ago, and then the banks came last week say, "Oh, hey, because of COVID-19, the market's not stable. We're going to have to increase your interest rate by 2.5%." So we at first they gave us 3.5%, which was good. So now they said, okay, either you can keep the same down payment and we'll raise your interest rate to 5.25%, which would instantly kill our cash flow. Or you can put $5,000 more into the down payment and then we'll give you a 4.0% interest rate. So basically I had to get Mitch's opinion, and we're already too deep into the deal to actually back out. And since we are house hacking it, right now we're gonna go with it, and then we're gonna refinance, and then eventually we're gonna get our cash flow back within 8 months. But that was a crazy experience, and that was my first time, so I didn't know really what to expect. But I learned a lot from this lender, and I know that I will work with them again, just because of there was a few faults. But I just wanted to add to that. Thanks.
Yeah, thank you, Sully.
No, yeah,
That's exactly. I mean, you said you knew exactly where I was going. I wasn't gonna use your name, so I'm glad you outed yourself. But that's the point: is that imagine you're about to close on a deal, and you have an agreement from the bank that they're going to give you, let's say, 3.5%, and then I don't know, 2 days before closing, they go, hey, you know what? That 3.5% we're going to give you, it's not going to be 3.5 anymore. It's going to be 5.2.
I'm guessing.
Or you can pay us more money. Question?
Just a comment. I'm guessing that at that point, this individual didn't lock the rate, right? Because I mean, typically you would lock the rate that would give you like 1 month, month and a half to do the closing.
Let's ask, Sully, did they let you lock a rate?
No. So we were supposed to close 2 weeks ago. And then for some reason, we never got a closing date. And then, so basically we were waiting on them to give us a closing date. But I don't think the rate never really locked. At first they told us, hey, congratulations, your loan's been approved and everything. They gave us a closing date, and we figured everything was ready to go. But apparently not. They just came out of nowhere and decided to change their mind and be bullies about it. But yeah, that was definitely a learning experience, lesson learned.
Yeah, and Kevin is chiming in that it's similar to his experience. And for the record, yours is, I've heard that same story at least 3 times, not counting you, in the last month and a half. And again, I'm not knocking banks, at least not right now. I'm just saying, be careful, because if it's a choice between the bank saving their own skin and keeping you whole, they're going to save their own skin. And we saw in 2008, they were yanking people's lines of credit, perfectly on time, good payment lines of credit. Banks saying, hey, I'm scared, we're going to take that line of credit away from you. And if you were relying on that line of credit to do business, you're now out of luck. So I'm just saying, don't get too comfortable relying on banks, because they can change the game. They can say you have a lock, and then they'll come up with some reason why that lock expired, and sorry, this is the new reality. And in Sully's case, he was past the financing contingency in the contract. So if he didn't close, he was going to lose his earnest money, the inspection, and the appraisal, which would have been a significant amount of money. And the banks don't think this is an accident. They know this. They understand that you are over a barrel, and they've got you where they want you. And so it's a stick up, basically. And so, and again, I'm not knocking the concept of banks. I'm not a big fan of them, but I'm just saying, use them when you have to, but don't ever trust them, because if they have to turn on you to save their own skins, they're gonna, and you're gonna be left holding the bag, is my only point. Someone's asking about my standard on ROI. My standard on cash ROI, and again, I'll speak entirely about the Atlanta market. I think it has to adjust based on the market that you're in, or at least I think it could adjust based on the market that you're in. But given what I can see in Metro Atlanta, I won't accept a deal unless I can get at least about 10% cash on cash. I don't have to accept a 3% cash on cash deal in Atlanta, because I know I can do better. So if I run the numbers and it shows me 3%, I'm going to adjust my purchase price until I get the 10% that I need, and then I'll move forward on the deal. And as I mentioned before, I'm looking for at least a couple $100 a month in positive cash flow, just in case things go sideways, as they sometimes do, and your tenants stop paying you rent for 3 or 4 months, if that sounds familiar to anybody out there, or something happens and things change and you need a little bit of extra cushion. If you don't have it, if you're getting $75 a month positive cash flow, there's not enough room there to protect you when things go sideways. And I want a bit more protection than that. I know we're running, we just hit the hour mark about 5 minutes ago. I do want to touch base briefly. Well, it's important to me that we answer any questions that we've got. I think we're getting some good questions, and I want to make sure that anybody who had a question is getting it answered. I'm trying to look through the chat.
I've got one more, Mitch, and I apologize for this
No,
one. I
that's
feel
why
like
it's
it is
here.
basic, but as far as the principal plus the interest for the annual,
Yes.
how are you guys coming up with that for the annual? Because obviously I know the monthly is just going to be divided by 12, but how are you guys getting that? Because that's what you're refinancing, right? And then multiply it by 0 or 0.035, or I'm miscalculating something somewhere?
Okay. So you're doing interest only. Banks are going to make you amortize. So they're going to, and that's one of the reasons, the other reason why I don't like dealing with banks is that banks, they want to get some of their principal payment as well as interest. So they're going to make you pay on an amortization schedule, typically 30-year am is the most that they'll do. So each month that you pay, you're going to pay a little bit of principal, very little, and a whole lot of interest for the next 30 years. And you've seen the amortization schedules. They cross over at some point. But that's why it's 220 and not 0.035 times the 49,000.
So where's the 2,640 then? How are we getting the principal plus the interest? How do we calculate?
That should be the 220 times 12.
Okay, so then where's the monthly 220 coming from then? If that's
Coming,
if we're running backwards.
It's coming
So this is
balance.
Yeah. So if you go to a calculator, a loan calculator that calculates what the payment would be, principal and interest for a certain amount of mortgage loan balance.
Okay. So that's just a different tool that we have to plug in for the estimated loan.
Right. And for the record, if you go to Google and put in mortgage calculator, Google does the exact. It's not as pretty as this, but if you go to the Google page and type in mortgage calculator, Google has a mortgage calculator built into it. And I use it all the time. Yeah. So you can put in a mortgage amount. It's really cool. And it's not pretty. It's not fancy. It doesn't give you the actual amortization schedule, but it gives you the same calculation as this. But yeah, so that'll tell you what the principal and interest will be, and it ends up being exactly 220.03.
Got it. Okay, awesome. Thanks, guys.
No, fair question. And so in this particular case, this is, just to remind you, this is Andy's presentation to his end buyer. So if his end buyer is a BRRRR buyer, Andy's presentation is, here's what you do, Mr. Investor. You're going to buy it from me at 80. You're going to get 4.36 cash on cash return until you can refinance it. And then you're going to refinance it for ideally an appraisal of at least 140. You're going to pull out as much cash as you typically can and still have a cash flow to your comfort level. And if you did it at 49,000, you would pull 166.47 and have a 9.95%, nearly 10% cash on cash return. And if they say, hey, that's a pretty good deal, then you can sell it to them at 80,000 bucks, and they should be happy with that deal. And you've achieved your goal. Yeah, and someone's asking what you make, Andy, on this deal. I'm guessing you're not prepared to share what you're going to make. Maybe you are. But let's assume that you got to be a decent wholesaler, you got it for less than 80,000 bucks.
I got it for quite a bit less than 80,000. To be honest.
Now, just for the record, if I were selling this deal, if you got it for a good deal less on an $80,000 deal, or whatever you actually got it for, you may be better served by serving up a little bit more meat on the bone for your end buyer. I mean, if you can get someone to do this at this rate, that's fine, but just be mindful that you may have to adjust, and I'm sure you do, that you may have to adjust that to accommodate somebody who's a bit more discriminating. But it lets me touch on a very important issue, which is, how do you calculate, if you're a wholesaler, how do you calculate your wholesale fee? And by definition, I'm glad you did it this way. You ran these numbers from the perspective of your buyer. So your buyer is paying $80,000, and they're getting, through a variety of twists and turns, in this particular configuration, 9.95. If they thought that 9.95 and 166.47 was acceptable, then they should be prepared to pay 80,000 bucks. But that means that they're not going to pay you 85 or 90, right? 80 is the most that they would pay for this deal in this existing configuration. Anything less than $80,000 and your numbers, anything more than $80,000 and your numbers would go down.
Right.
So let's just use it as an example. Let's say you got this under contract for 75. I'm sure you did better than that, but if you got it for 75, then that means if you have a contract with your seller at 75 and the most your buyer is willing to pay you is 80, that defines what your wholesale fee is going to be. It's the difference between what you can buy it for and what you can sell it for. In this case, $5,000. You cannot just arbitrarily say, hey, I'm going to make $10,000 on this deal just because you want to. No, the most a smart buyer in this case is willing to pay is 80. And if you got it at 75, then you can't get more than, at least under the conventional structure that we're talking about here, cash purchase, you can't squeeze $10,000 out of that deal because it's not there. And I know this is not a wholesaling course, but I want to make sure that people are clear on the fact that wholesaling does not mean buy it for some price and then slap some arbitrary amount of money on it and then make that available to your end buyer. I mean, you could do that, but it doesn't work that way because they're going to run the exact same calculation that Andy just did. And when they run those numbers at $90,000, it's going to be like 6% cash on cash. And they're going to go, no, that's a bad deal. I'm not going to do it. So you're not going to get any smart investor to pay you more than $80,000, assuming that these are the numbers that they want. So 80 is the most you can get for it. And if you only got it for 75, then that defines how much money you're going to make. I see it all the time when Bigger Pockets people go, well, how much money should I charge for my wholesale fee? You don't get to decide what that is. You get to decide that by determining how cheaply you can get this. If you can get it for 70 or 60, then yeah, you can make a bit more money. But once you've got a contract locked in with your seller and you know how much your buyer is willing to pay for it, that by definition is your wholesale fee minus expenses. So you don't get to just arbitrarily say, hey, I want to make twice as much as that. No, you make what you make. You're earning that money because you're finding a great deal and then you're selling it to somebody at a decent deal. You're finding an awesome deal and selling somebody a great deal and taking a little bit of spread in the middle. You can't take a horrible deal and sell somebody a crappy deal and you expect to take anything in the middle more than once. You may be able to get one person to buy your crappy deal, but A, they're never going to buy another deal from you. And B, if they buy that horrible deal and go under, you've just ruined someone's real estate career and you're not, in my opinion, a very good wholesaler. So I'll get off that soapbox, but I just wanted to mention that real briefly. I see that there's some questions coming in from the chat.
If you don't mind, I can say really quickly for people who are interested in wholesaling, a way that I like to come up with a wholesale price.
Yes, please.
Is, of course, there's a 70% rule, but I like to kind of see what the market has done with solds, what investors have paid for properties, and then you can see, what it looked like sometimes. So someone paid here 99 for a smaller house, but anyway, you go comparable. And if you found one that looked like it was a cash buyer, then you can contact the realtor, the listing or buying realtor for the cash buyer. And then you could ask that realtor if that person's interested in your new property, and you'd have precedence of the price that they bought it at. So it's a nice proven way to get buyers in your neighborhood without even really having any cash buyers in the first place. And it does work as a first point of contact for shopping your deals and possibly setting the price. But 70% rule usually is the best. And for rentals, usually you can go a little bit above 70% rule because it's not so much an equity play as a cash flow play. So as long as it works, you can go a bit higher. But anyway, you can go ahead with the other questions.
Mitch and Andy, I do have one, and it does kind of fall into the wholesaling. That's the only reason why I just want to spit it out real quick. In any world, would it make sense where, like, let's say, let's say you got this for like $60,000, right? But let's say I don't have $60,000. Is there any way that, or any particular loan, or is there anything that would make sense where you would draw out money from the bank prior and then be able to kind of use that to fund a deal initially?
Well, when you're wholesaling, ideally, you don't ever have any money into the deal, just the earnest and option money that you might have put down could be as little as $10, theoretically. No, I mean, if your spread is big enough and you don't want anybody to know how much you're making, you could use something called transactional funding, and they charge anywhere between 1% and 2% of the loan amount. Plus, you know, they cover closing costs customarily. So it's actually very cheap. And it's a good way to mask how much you're making and technically be on title for a short period of time, for a day or two. In Texas, you have to disclose to the seller if you're going to assign the contract, and you have to put in a clause that says buyer and or assigns, so that they consent to what you're doing. But if you have a big enough spread, you don't have to even tell them what you're doing if you use transactional funding, at least in Texas. So that way, because you're actually a buyer, you actually funded it, you actually closed, you're on title, you just happen to sell it a few hours later. So that's the only time I'd really consider funding. You don't really need the money. That's the beauty of it. And that's why a lot of beginners go into it. And the fact that it's transactional makes it very scalable. And the risk is very low because you're just risking earnest money, basically. I don't know that answers your question.
Okay.
So David,
yep.
your concept was exactly right. It's just that where you'd go is not to a bank. You go to an individual that will lend you the money for a day. So
Got it. Okay.
Andy wanted to close, let's say his number is $70,000. If he says, hey, I want to buy this thing for 70 and then turn around and sell it for 80, there are people out there who will lend $70,000 for 24 hours. And if you think about it, it's like shooting fish in a barrel for them because there's no risk. You're going to close you're going to close it like 2 hours later. So at no point will Andy ever really see the money. It's going to go right into the attorney's escrow account. It's going to sit there for 2 hours and then go right back out. And then the 10,000 that's left goes to him, and the person gets their money back immediately. So there's minimal risk. And if they could get a point on that, let's say 1%, doesn't sound like a lot of money, but they're getting that in a day. So if you did that like 10 times in a month with that same 70,000 bucks, you're making 10% in a month. Which is not a bad return. So from the standpoint of the transactional funder, this is awesome business. From the standpoint of Andy, if it costs him a point, then he spends, now that's kind of high, but a point is 700 bucks, right?
Yeah.
So for 700 bucks, he gets to hide his price from his end buyer so that they don't get ticked off, and from his seller. And that's worth it in my mind, to have that peace of mind.
Okay. Yeah. I was because that was my next question is how does the person that's lending you that amount of money, how do they benefit out of this whole? Because I doubt anybody's going to want to just be like, yeah, here, out of good faith, here's.
Well,
Yeah.
some friendlies might, but we're not talking about a ton of money. We're talking about, it doesn't sound like a lot, but when you think about it, if you're doing this on a regular basis, if that's, and there are people who do that, they just make funds available for transactional, for transactions. And if they can do 10 closings a month, I could take that same 70,000 bucks and go from closing to closing to closing, collecting 700 bucks each time. I've just made, at the end of that month, I've made 7,000 bucks on $70,000. That's 10% in my book.
Yeah, that's just been reused.
Yeah, it's exact same money just used over and over again. And my risk is zero because I'm not paying it to, he's not paying that money to Andy. He's wiring it to the attorney, and then the attorney wires him back all his money plus 700 bucks.
Right. And they only usually do that once they know that the end buyer has their funds in escrow waiting.
Yep.
They won't do it first.
I'm sorry, can you just repeat that last part again?
That they won't actually wire in the money until they know that the buyer, the end buyer, has their money wired in already. Because that's the only way they'll know that they're going to get their money back. They're not going to do it first. But
got it. Okay. Awesome.
And there are plenty of transactional lenders out there. In fact, we were offering transactional funds. You can also, in some cases, in some states, in Georgia, they'll let you do double closing. So you can do your B to C closing first at like noon, and then do your A to B closing at like 2, and use the funds from your B to C to fund your A to B.
Right. You can do that in Texas too, but you have to disclose to both parties what you're doing.
Yeah, as I say,
often the buyers aren't comfortable with that.
Got it. And in most of our cases, we're dealing with investors who honestly don't care what I'm making as a wholesaler. As long as the deal is good for them, why should they care? They had to do no marketing to find this deal. I put it in their lap and served it up with sterling silver and a nice napkin. I mean, there's really no reason for them to be upset. And I'm doing multiple deals with them. So this is not typically the first deal I've ever done. They're happy to pay as long as the numbers work for them.
Right. And
I do want to throw one quick thing out there because we don't often, because I typically talk too much, we don't often get to phase 3. but I just wanted to ask the question because I had to. You said, Andy, this was a vacant property, correct?
Correct.
And I assume, is it safe to assume that there was no debt on this property?
It's free and clear.
Was there any reason why, or maybe you did, is there any reason why you wouldn't have made a finance offer to the seller?
I did not. Why? Because I guess I just want the quick cash. I didn't really consider that.
And that's all. And as I often say, a quick nickel is better than the slow dime. So I'm not saying that it's bad. I'm just saying if I were looking at this and say, okay, and again, this is from the standpoint of the end buyer. So at this point, Andy's already done his magic, and so we're not going to try to re-adjudicate his deal. But if I were Andy and I had talked to this seller who's got a free and clear house that's vacant, which means they're making nothing on it, I will always make a cash offer, a lowball cash offer, but I'll also make a terms offer, because if I can get financing, and if they really could benefit from the financing, then I can pass that financing on to my end buyer. And so instead of them having to burr and pay closing costs and all this other stuff, I could potentially finance them right into the deal.
Yeah.
And I know this is not an owner finance deal, so doing the math on that would require a whole another hour or two. But my only point is that this is just a general comment that my recommendation is to always ask or present a term. In the case where it's a free and clear house, there's no underlying debt, and no one's living in it, there's no downside to offering a terms offer, because if they say yes, those almost always beat the heck out of a cash deal, because you can always pay them the cash. You could do a terms offer and then turn right around and pay them all their cash the next day. No one's going to complain about that. But having the ability to pay them over 10 years, let's say, is awesome and makes it trivial to sell. And I know, and those people here on the call who know me know that when I'm selling to particularly overseas investors, they go crazy over financing because they can't get that in their home countries. So that doubles, in some cases, doubles the value of the deal for those folks, because they can't get that. You can't get that in Europe. You can't get that in most other countries. And so in Australia, you can't get that there. So I would just say the only thing that I would consider as a phase 3 strategy here would have been to, when I'm making the presentation to the seller, just casually ask, so, is it the case that you need to get, what are you going to do with all your money once you sell it? And I'd ask it in a nice way. I'm not going to try to be nosy, but I'm just curious, what's your plan once you get all this money? And if they say, hey, I'm going to buy a boat, okay, fine. You may need 70,000 to buy, or whatever the number is, to buy a boat. But if they're going to say, well, I'm going to go, spend some time down in Florida fishing, then what if we could pay you for the next 10 years? Every month you get a nice big old check that you don't have to do anything for. Would that be, and we pay you something up front right now, would that be acceptable to you? Would that be desirable to you? Would that be helpful to you? And if the answer is yes, that's a whole different ballgame. And again, I know it's beyond the scope of this, but that opens up a whole beautiful can of worms that can benefit everybody. It benefits Andy, it makes his deals fly off the shelf, it benefits his buyer, and it potentially benefits the seller from a tax standpoint. So I'll throw that out there because we don't get a chance to talk about a phase 3 strategy, but that is an example of a phase 3 on the A to B transaction side that could be a significant enhancement on the deal. But as it's spelled out here, Andy, I think you did an excellent job of laying this out. I like your format. I may actually steal this for my own because I think it's very
great,
organized and pleasing on the eye. But thank you for presenting this. It was very easy to understand. And again, I would encourage those of you out there listening and who have seen Andy's, hey, Andy, why don't you throw up your Bigger Pockets page?
Here's my Bigger Pockets page.
And so there's Andy's.
As well.
Can I add something afterwards?
Absolutely.
This is solely something related to phase 3. So one way we actually were able to make our deal better by increasing the cash on cash return was just by simply asking the seller if he was willing to pay some of our closing costs. And all we did was ask. We didn't think he was actually going to do it, and he said yes. And that simply increased our cash on cash return by 2 to 3%. So I guess my take is to always ask. It never really hurts if they're willing to pay part of the closing costs.
Absolutely right.
Thank you.
Yeah, that's an excellent point. 20 years ago, I heard Ron LeGrand say this. I can't remember where, but he said the highest paid profession is someone flapping their gums. It's amazing. We've had situations where you're just talking to somebody on the phone, and in a minute or two, you get them to go down on their price $35,000. How do you calculate the return on that investment? I said some stuff into a phone, and the price went from 100 to 65. That's just magic to me. The fact that that's even possible still is magic. So ask the question. The worst they can do is say no. And if you ask it the right way, they're not going to be offended. But if you don't ask, they're never going to tell you. No, owner finance deals are never found lying on the ground. They're always created, and they're created by asking good questions. So, but again, that's not a critique of this. This was an excellently presented deal. I'm just saying that it is my habit to always ask that question, because that opens up a whole amazing set of opportunities for you. I know we are way over, so I'm going to ask if there are any final questions. I'm trying to keep my eye on the chat. I don't see any. Well, let me pull it up here. I didn't see anything. People are congratulating you on the job that you're doing, Andy. Yes, someone's asking about owner financing. Owner financing, seller financing, it's all the same thing. Someone's asking about the terms. Unfortunately, as I mentioned before, phase 3, there is no formula. It is entirely a function of what the seller wants, what you need, what's possible, what's viable. It's a conversation, but whatever conversation you have, if they're even willing to consider it, going down that path will always put you in a much better place than just taking cash, because at least you have the option. You can always pay. No one's going to be offended if you pay them cash. But if they're willing to consider financing, you can go as far down that road as you want. And sometimes you'll discover some amazing stuff at the end of it. And it only happens when you ask the question. So to the point that was made before, just ask. There's no downside to being inquisitive and just asking about what their needs are and how you can perhaps serve them better. We are way beyond our schedule. Assuming that no one has any pressing questions that we didn't cover, Andy, I'll say congratulations on presenting an excellent deal here. Thank you so much for being brave and giving us an opportunity to ask you lots of great questions. It was an excellent analysis. I would encourage you folks out there to connect with Andy. He's the kind of person you want to have in your network. And I'm not kidding when I say that that your network is the value that you have in this business. This is all about networking. And so if you think you might want someone like Andy in your network, then reach out to him on Bigger Pockets and connect. So this will be up on the channel, on the YouTube channel. I'm guessing the next day or so. Karina will hook that up. But in the meantime, I'm just going to say thank you all for joining us on the call. Hopefully it was beneficial.
Mitch,
Yes.
do you want me to do the second poll real fast before everyone?
Oh, yes, please. Before anyone heads out the door, let's do this final poll and and see what, for some reason, I'm not seeing the polls. I guess it's because I'm not logged in separate from you, Karina, but let's run the poll and get some feedback. We're trying to get some guidance from you as to what kind of topics we should cover, what kinds of areas would be of interest to you.
I'm just a quick question regarding the poll. What exactly is subject to?
That's a good question. In a nutshell, subject to is a technique for taking over properties where there's already an existing mortgage in place.
Perfect. Thank you.
In one word, it is magic. It is. When I discovered subject to, I thought it was the greatest thing since sliced bread, and I still do. It's just magic. It's just incredible. So anyway, Karina has the link for the next call in the chat. As you can imagine, this is like the other ones. It's DDD bit.ly/DDD all caps June 18. We've already got someone scheduled. If you are feeling confident and are willing to put yourself forward to present, then please do contact Karina directly at karinad@home-pride.com. And otherwise, I thank you all for being here. I hope this was of value to you. And I encourage you to reach out to each other and support each other going forward, because I'll tell you, times are about to get interesting, and having a solid network is going to be what gets you through it. So take advantage of this opportunity to connect with each other. Thank you all for being on the call, and we'll talk to you next week.